assessment will involve these 6 issues: business risks, audit risk. We are going to say the 2 things, alright, what we are going to look at. Now, within audit risk, we should be able to identify significant risks. We should be able to understand critically creative accounting, which is inherent risk, and fraud, which is also an inherent risk. And we should also understand internal controls and control risks. That's what we do in this stage. So on step 3, risk assessment in audit planning. So we said audit planning overall, we will start with understanding your current business. Then we should identify those risks which can distort the financial statement. Remember, as we are understanding the entity, we should be able to identify risks. So we want to teach you on how we identify risks. Remember, one of the main reasons for understanding is to identify the risks which affect financial statements. So in risk identification, or in this audit planning phase, the auditor is going to use a risk-based approach. So in this based approach, you as an auditor, you should be able to move from business risks. So you look at the risks which affect the business. Then after that, you look at audit risks which affect an opinion. So whilst understanding audit risk, you should understand critically creative accounting, fraud, and weak internal controls. So how are these key areas affecting audit risks? So the first thing to understand is business risk. So what is business risk? Business risk is a risk that the entity will fail to achieve its objectives. What are the objectives of the company? Profit maximization, employee welfare, customer satisfaction, speed of delivery. So there is a risk that the company cannot achieve these objectives. Now the question is, what factors will cause you to fail to achieve these objectives? So there are 4 risks that are going to cause the failure to achieve objectives. These include operation risks, compliance risks, and financial risks. We should understand these risks because at the end of the day, they are going to lead to audit risk. So in your exam, it's very likely that you'll be asked business risk and audit risk at the same time. So you should be able to differentiate the 2. Business risk will affect the entity from operating, while audit risk will make the auditor make long conclusions. You should differentiate the 2, because the auditor can say identify audit risk, the person can say identify audit risk, you are answering business risk, or identify business risk, you are answering audit risk. So business risk, operational, compliance, and financial, while audit risk will be having an inherent control and detection. Take note of the difference. However, you should note that these business risks, if not well managed, they can also lead to audit risk. Let's start with these types of business risks. First, what is operational risk? So operational risk arises from these 5 items or 4 items. 1, failed people. Failed people, we mean people are not carrying on their work as expected. 2, failed processes. Maybe HR processes. Yes, before you pay an individual, first of all he has to sign. Then you find out that person has not signed. Failed systems, maybe viruses crashing the system, or external events, maybe national disasters, thieves. Examples could include machine breakdown, stops production, poor inventory controls, which can cause theft or obsolescence. IT failure prevents sales, payroll, or receipts processing. Staff turnover could also lead to accounting errors because staff are leaving, so we have got very few accountants. And also weak procurement controls, which will cause long practices or duplicate payments. Those are some of operational risks. Now, Having identified those operational risks, what could be the implications for an auditor? One, inventory may be overstated or incomplete. Examples would be where we have got fewer store staff, so the people will be stealing, or people are not converted with IS2 requirements. Expenses or liabilities may be misstated. That's obvious. So if you have got a poor system, revenue may be incomplete. It is not recorded in time due to failures in people as well. Cut-off errors may occur. And also, asset existence may be doubtful. You might doubt the existence of an asset if they are operational risks. What about compliance risk? Compliance risk results due to failure to comply with laws, maybe labor laws, taxation laws, or regulations, or you are not complying with accounting standards, or you are not complying with tax rules, or even contracts. Examples: late or incorrect tax filing. So tax is due on 23 January, you are submitting on 30th January. Environmental breaches. So maybe you are not protecting the environment, you are dumping waste into rivers. Violation of bank covenants. So you have to pay your loan on the 25th of every month, then you are not paying. Incorrect application of IFRS, failure to make statutory disclosures. This could be some examples. So if you fail to comply, this could be the implications. Provisions may be required, so if you don't follow environmental laws, you should expect to recognize provisions. Contingent liabilities may exist, because if you lose a case, you might be sued, so you might recognize liabilities. Going concern may be affected. Disclosures may be incomplete, because if going concern is affected, it means you have to disclose going concern, so they'll be affected. Fines or penalties may need recognition. Remember, what we're trying to say here is having identified these business risks. Alright? Now, how are these going to affect audit risk? How would these business risks lead to audit risk? So this is audit risk. So where business risks, they are now becoming audit risks. So at this level, we want you to be able to know how business risk can turn to audit risk. Okay, for example, if the examiner asks you, what are the audit risks, or what are the business risks? So you say, there's late, you write a heading, late tax filing. So how are you going to answer this? Because you're going to say, this could lead to the company incurring additional costs on expenses. That's the business risk, leading to low profitability. That's the end of it. But now, what is the audit risk? The same thing can lead to an audit risk. So I've said the audit risk, if you are not filing, is that it will lead to recognition of provisions. So remember, an audit standard should always, an audit risk should always lead to incorrect application of an accounting standard. So that's how you know that this is an audit risk. While business risk is not related to accounting standards. Take note of that. Finally, financial risks. Financial risks arise from liquidity challenges, borrowing, interest rates, exchange rates, and credit exposure. So these issues lead to financial risk. Example, over-depending on overdrafts. Debt repayment pressure. The debt is due tomorrow, but you have not yet paid. Rising interest rates. Foreign currency borrowing. Customers paying rates and straining cash flow. So these are good examples of financial risks. So how will these lead to audit risk? So they can affect your going concern status. If they affect your going concern risk, it means that is IS1. IS1 requires the disclosure of going concern risk. Okay, we'll be learning the standards, we'll be applying this to the standards. And then liability classification issues can be affected as well. Foreign exchange gains and losses, we have IS 21, which says foreign exchange gains and losses should be recognized in OCI. Receivables impairment, which is credit loss, because if your interest, you are struggling to pay interest, it's a sign of credit impaired assets. Then also covenant disclosure. There's a risk that you may not have disclosed the covenants. Questions on business risk and how they tend to audit risk. So I always repeat, this is the key question in the exam. You always have a question on audit risk and business risk. So what is audit risk? So audit risk is a risk that the auditor expresses an inappropriate opinion when the financial statements are materially misstated. What we mean is that the financial statements are available, but you are saying they are true and fair, but in actual sense they are not true and fair. Why? Because they are audit risks, or there are issues, there are material misstatements. For example, there's fraud taking place, there are errors, there are updated standards being applied. So as an auditor, you should try to avoid this audit risk. So audit risk is made up of three issues: inherent, control, and detection. Take while audit risk we have said is what? Operation, compliance, and financial. Take note. So audit risk is calculated as inherent risk times control risk times detection risk. Now, these components of audit risk, based on other books, they just say audit risk is into two. We have financial statement risk, which we call it as risk of material misstatements, and detection risk. Now, financial statement risk is divided into two: inherent and control. So this is a risk that the financial statements are materially misstated, which is not the fault of the auditor. Now, if the auditor has carried out working and has said the financial statements are true and fair, and he did not identify fraud, that auditor will win in court. Why? Because it's not the responsibility of the auditor to deal with inherent and control risk. Take note of that. But detection risk is also known as the auditor risk, because if this goes wrong, the auditor will be sued. So the auditor should use maybe correct samples to prevent that. So take note of that. Now, what is inherent risk? Inherent risk is a risk of material mistakes which occur due to the nature of the transaction and the company. So this risk occur because of the way the company is. For example, a bank. People at the bank churches can even deposit 5 kwacha a day at the bank. So it's a risk because of the nature of the transaction. 1 kwacha can still be available at the bank. So there's a risk that something can go wrong because of the nature of the business itself. Or sometimes the complexity of accounting standards in that business. In the banks we have got credit loss, which might be complex for other people. We can also say inherent risk is the natural applicability of an account or ascension to the statement before controls are considered. What we mean is something could go wrong in the accounts, but not related to internal controls, not due to poor passwords, not due to lack of segregation, but they just happen because of the nature of the entity. Now, as an auditor, these are some of the inherent risk areas. They are not the only ones. I should remove this. It should be inherent risk areas. One, maybe inventory is overvalued or sometimes undervalued, impaired assets, inaccurate estimated provisions and contingencies, inability to disclose going concern, poor estimation of deferred tax assets. Revenue recognition can be complex. Remember those 5 stages of revenue if you have read before. Receivables recoverability is an issue. Impairment testing, fair values, maybe IFRS 13 issues, and related party balances. This could be some of the inherent risk areas, not the only ones.